Okay. Um, well, welcome everyone to our talk today, where I've got the pleasure of having a chat with Roy Bejarano from Scale Healthcare about a bunch of current issues, essentially, in the physician practice management, or the professional practice management industry. Um, we're going to spend some time batting about a bunch of different issues that are sort of, as I said, current issues, and then we'll take some questions towards the end. You can put your questions in the chat either as we go along or towards the end, and we'll take them at that point. With that said, Roy, why don't you introduce yourself?
Hello, everyone, and thank you, Ari, for inviting me to this webinar. My name is Roy Bejarano. I'm the co-founder and CEO of Scale Healthcare. Scale Healthcare for the past 5 years has been one of the fastest growing consulting companies in the country, with a narrow focus on healthcare services and nothing else. Within healthcare services, we offer many different solutions. So from integration work on practices that are being acquired and integrated into larger platforms, full suite of due diligence capabilities, to turnaround work, which is more befitting the current environment that we're in, it seems, to performance improvement that we do team by team. We have dedicated teams and businesses. For example, we have a healthcare marketing business, an office of the CFO business, an RCM consulting team, along with our outsourced business. We have an ASC development and management and performance improvement team, an IT data analytics and dashboarding team, which has since expanded to include cost automation and cybersecurity. We have our own dedicated compliance team, our own exec C-suite search plus mid-level management search team, our own payer contracting team. So we just have a lot of dedicated groups that each on their own bring cumulative 50, 80, 100 years worth of experience just in their space. And all of them have grown up in just healthcare services. So it's an unusually rich quantity of experience for your typical consulting organization that does some healthcare. So we are definitely differentiated from those groups. We've also built Scale Community, which over the last 6 months has grown into 230 members, of which the majority are CEOs of healthcare companies all over the country. I think probably the fastest growing healthcare community in the country. Hosted our first conference last week for 200 of those CEOs here in New York. And so a very vibrant, dynamic community that engages a lot of content sharing and increasingly a growing amount of advocacy work as well.
Thanks, Roy. And I get to basically pick Roy's brain for the next hour about a whole bunch of issues. I am, again, Ari Markenson. I am a partner here at Venable in our corporate and healthcare practice groups. I'm the co-lead on our healthcare group. And I do a lot of M&A and healthcare regulatory work in the healthcare services space. And it just so happens that by virtue of what's going on in the marketplace, particularly, I've done a lot in the PPM space in the last few years. Even I've done before that, but it's certainly been busy in the last few years. Roy, why don't we start out with our first sort of topic, which is, and frankly, if I'm reading the most recent PitchBook Healthcare Services report that they literally put out yesterday correctly, healthcare services transactions in the PE space, particularly in the middle market, are as of September 30th, their data was of 2023 was only at about 50% of what had happened in all of 2022. And I don't think that's surprising to a lot of folks. I suspect, Roy, it's not very surprising to you either. But that is part and parcel of a larger market. I don't mean this word in the way folks may take it, depression, in the sense that there's just not a lot of deal making happening. And in healthcare, the amount of deal making in healthcare services, particularly the amount of deal making that's happening, maybe a little bit off of the numbers that are in the broader marketplace, but not much different, kind of on the same downward trajectory, unfortunately. And with that said, however, there are some spots in the PPM space where things seem to be a bit resilient. There are some spots where things are not happening. But let's talk about kind of why there are still certain types of transactions happening in the PPM space, not others. You and I had an interesting debate about this yesterday in terms of where we thought things actually weren't happening. But give us your sense of kind of what the state of play is, right, in physician practice management deals right now.
I'll give you. This isn't scripted, so it's thoughts that come to mind. You did ask a pretty broad question that has many broad elements to the answer. So if I waffle on, just interrupt me, because it's one of those questions that I love to get because it just is an open door. What is the state of play? Why are deals happening? Why are deals not happening? The not happening is sort of tried and tested, but the nuances are, larger deals, more debt financing, more dependent on a healthy capital markets environment. We don't have that. So if you're a large fund, on an absolute basis, borrowing hundreds of millions of dollars is very scary when you're not quite sure of the future. And on a relative basis, it seems a lot more unstable today than it was 12 months ago. And fuel to that fire, that again, a lot of people are spending time on the fire, a regulatory environment that's weakening, a geopolitical environment that's weakening. Probably the only good macro element that we can hang our hats on over the past 6 to 12 months is that inflation has consistently come down. But even there, it's a qualified component of good news or element of good news because it's still higher than it historically has been. So there just isn't much good news to go around. And if you're a lender, you're mostly dealing with credits that are underperforming. And if you're a sponsor, you're dealing with assets whose margins are weaker than they've been historically, whose free cash is thinner than it's been historically due to that inflation, due to those interest rates. And so it's not an environment to go shopping. And I think the numbers really reflect that. You asked a funner question, which is why deals still happening at all. And there, I think you really open the door to a reminder of all the things that we love about this space. And the list is long and actually getting longer. Those moving bodies of very positive influence, big planets that are rich in vegetation, in fauna, because they're gonna yield growth and earnings and success and happiness and investment and improvement. Those planets are still circling up there in our solar system, our healthcare solar system. The ASC trend is still alive and well. There's continuation of transition of inpatient procedures to outpatient. Cardiovascular is a good example. Bariatrics is another example. Every one of those CMS new ASC eligibility transitions represents billions of dollars of new investment that will happen, that is happening. The recognition of entire specialties as capable of consolidating and professionalizing and scaling to what? Scaling towards better businesses that are capable of taking on bigger challenges. That's happening in areas that, only recently had no idea that they were capable of doing that. Aesthetics is a great example. Plastics is a great example. Fertility is a somewhat later example, but still quite recent. So the education of the entire marketplace from an investor standpoint and from a clinician standpoint is still happening and still opening the door towards brand new markets that are very greenfield. That's very exciting. The application of value-based care, risk-based reimbursement is still in the first inning. Primary care plus what? The connectivity of primary care to single specialties, not just for the benefit of primary care payers, ACOs, but also to the benefit of those single specialties, is really going through experimentation and will prove very successful. The introduction of strategic acquirers on a massive scale, the internationalization, the transition from domestic only to global brands buying US healthcare assets, not just at the margin, at the fringe, but at the core. Amazon is a global brand. So is Walmart, so is Walgreens. These are not domestic brands anymore. They've been international for decades. Those assets buying, pick a state, primary care providers is revolutionary and offers interesting exit capabilities, IRR possibilities if you're forecasting out the return on investment. That's just a little taste. There's so much more. There's the introduction of virtual care, which is really, as far as the market is concerned, virtual care was born 3 years ago, birthday COVID. Until then, so no one took it seriously. Reimbursement rates were too low to justify real investment. So it's one of those fringe things that only technology geeks were focused on. Now it's relevant to everyone, everywhere, and for good reason, because it really does work, and it is deflationary, and it does create capacity. Where the biggest issue in healthcare up until the last 3 years ago was shortage of supply, right? The inability of our academic institutions to really generate kind of clinical supply that we need to meet demand. There's this small thing that's never mentioned anymore of the baby boomer generation, the demographic trend, transitioning into a much greater need of more healthcare with much higher expectations in terms of quantity of care and much higher consumption capabilities. They represent, I think, 80% of the wealth in this country is held by 20% of the populace. They're going to be particularly focused on their health for the next 20 years. So, we have this, I don't want to be facetious about it. I don't want to be too flippant about it. I don't want to call it a momentary blip, because the macro environment we're in right now is very, very serious. I don't want to call it dire, but it's definitely, from a risk standpoint, not what any one of us has been used to, for a number of reasons. Global pandemics, inflation, the hottest geopolitical environment that we've seen in a long time, bipolar extremism from a domestic standpoint. There's lots to be concerned about, but you have to keep in mind what the other trends are, what the other value generating opportunities are, and basically make the calculation. Will this macro environment continue and or worsen for the next 20 years? If it does, these periods do happen in human history. If it does, it's unusual, right? The usual is a return, a regression to the norm, and the norm is a lower risk environment than we're in right now. So we'll see. I think it is an interesting time, and frankly, it's a time where valuations of assets should be lower and deal volume should be more selective. But there's plenty to be excited about if you're an operator in healthcare. Prices, I leave pricing to the bankers. Building businesses, now's as good a time as any.
Yeah, it's interesting. A couple of observations, and then I want us to move on. The same PitchBook data, right, and even other data that I've seen, healthcare-focused funds are not having trouble raising new funds, right? The other macro issues that make healthcare investing as a whole, right, so enticing, have not changed. Those positives are still there. The interesting thing about the fact that we've got an aging population is that there's just from a very macro level, I could get into, and you could too, into the detail, but from a very macro level, right, an aging population equals more individual amounts of comorbidities per person, right, which equals the need for more care and so more services, right? And I'm being insanely overly simplistic about that, but that's just one of those very large macro trends.
I didn't even mention the transition to home care, right, which is another blossoming space, and the integration of home care and virtual care into brick and mortar traditional care, which is also incredibly deflationary. So lots of exciting things out there. I think for those that overpaid, balance sheets are disjointed from present day reality, overbought, too many assets too quickly, under integrated. It will be a difficult time, but I do think there's this habit that investors have, unfortunate habit of blaming the industry for one or two bad assets that they're partly involved in that didn't execute well. There's nothing wrong with the veterinary space.
Yeah.
Right. The veterinary space is fine. Volumes are fine. Reimbursements are fine. Demand is fine. Maybe the growth of pet consumption isn't skyrocketing like it did during COVID. But the US consumer is still consuming a lot of vet goods, a lot of vet services. And I think there's something wrong with a vet asset that is levered 10 times, that currently has gone from acquiring 5 to 10 vet practices a year to zero, and is trying to sort of make sense of that. One is an anomaly, frankly, and the other is a commentary on the health of an industry. I think you can use that analogy and apply it to nearly everything in healthcare.
Yeah, I think
There's very few spaces in healthcare. Include pain in that. Include anesthesia in that. Pick the most ugly spaces that have really been the most complicated, have been subject to the most volatility, and they still have a lot of fundamentals to them that are particularly strong. So it has always been a space that everyone involved in has to tread very carefully, and it's always been highly regulated. It's always been subject to constraints in supply. It's always been a people business. It's all been subject to clinicians and their individual needs. Those conditions have always been there, but for those amongst us who have been very careful about investing, there are a lot of investors that bowed out of 2022, that just didn't participate at all. And frankly, I think for those, 2023 might seem a lot more attractive.
Yeah, it's interesting that and you and I batted this about a little bit yesterday, but I think that the in the PPM space, it's kind of spreading, crawling a bit, because it still has those dynamics of being very fragmented, lots of opportunity on a very small scale, right? And you have scenarios in which you can pick up onesie twosies without debt, right? And potentially keep growing your platform in a way in which you're not going back to get an add-on to your debt, your major financing or otherwise. And so you see a bit of that happening. You also still have the dynamic of a lot of founders of small practices, right? And even some in larger practices who throughout the pandemic really got punched around and said, I don't want to, on a go-forward basis, be the person responsible for whether or not the lights stay on, or whether or not the receptionist keeps getting a paycheck, or those kinds of things. And if I can find someone to partner with, like a PPM, right, who will come in and give me a nest egg for my retirement account and let me just be employed for a while, that's changed the dynamic of the thinking of professionals in some way, in the sense that the older portion of even Gen X, for example, is starting to say, when they're 55 now, right, that hey, I built a nice practice, but I don't know that I want to do this for another 15, 20 years in this way, that I have to personally be responsible for the operations of this place, right? I want to see my patients. Yeah, sure I do. And that attitude has changed. And you also have the attitude from younger physicians wanting to just be employed. And I think that that's had an impact on how PPMs are able to still be somewhat successful at continuing to do acquisitions as I said, in a smaller portion of the marketplace, while we're seeing that, this buying and selling of PPM platforms, right, is sort of at a standstill, right? That's not happening as much as we see it on a very small level. With that said, why don't we move on to sort of the next issue that we talked about, which is, it's all wonderful to say that this is going to change, hopefully at some point. There's some things that we expect to make to change the dynamic and return us to a sort of what we would think of as a normal pace of doing transactions and those kinds of things. But against that, we have a lot of particularly state-based regulatory changes, whereby the PPM industry has really not been an industry where its transactions were regulated, right? They never had to get an approval to buy and sell themselves, right? They never had to get any kind of, they never had to notice anybody or tell anybody that they were going to buy a practice or sell a practice. And we're, I don't know, our 12th or 13th state so far that's passed a law that essentially requires something to that effect right now. I wonder if you've got some thoughts about the, these what are some pretty significant regulatory transaction review issues that have come up, and the fact that the dominoes seem to keep still falling, in the sense that more and more states seem to be interested in regulating in this area.
Yeah, no, it's a very interesting topic. I mean, you can take many sides to it. You can be critical of what the foundations are that are supporting this changing regulatory environment. What is the research? What is the empirical data that's driving these new regulations? And I would make the argument that all the data that I've read, all the reports, are very weak, very thin, and very leading. There seems to be no room for counter argument, very little room for depth. So it does feel like an impulse reaction, almost like they were caught unawares. And you can see why there was very little reporting, because most of these transactions are MSO transactions. They're business assets. They're not really clinical transactions. Clinical PCs remain unchanged. So just the nature of how this thing was structured sort of lends itself to a little bit of confusion of what's happening, why, and where. So counter argument to my own argument, there's nothing wrong in transparency, and frankly, the more information, the better. And if all that's being asked for here is accurate reporting, we should applaud that. The more accurate the reporting, the more honest and objective audience members that have the best interests of everyone at heart will find that really good things are happening in healthcare. And where they're not, then the right response is appropriate. So shine a light, please. Where I think the mind wanders is this really going to remain objective, or is there going to be a hidden bias and a hidden door opening for subjective decision making that's sort of partisan, right? Yes to health system acquisitions, yes to Optum United, yes to Ascension, yes to Walgreen, but no to Mr. or Mrs. Private Equity Group. So where you start to pick winners, things get a little unfair. And I think in the past, a lack of oversight sort of created a free market environment where the winners were the winners, and there was less subjectivity applied to that, and that seemed quite liberating. So we are entering, I think, a more I would say risky time, where real controls might reside elsewhere. I mean, I know the reality of the CON space very well. I grew up in the CON space in New York healthcare. So there's committees making decisions about whether your business is going to grow or not in a given year, and that is certainly nerve-wracking. So yeah, it's a changing dynamic in many respects. I will say, to your point earlier about transactions and physicians retiring and wanting out of the environment that they're in. They went through COVID. Were they a necessary service, a discretionary service? These are sort of all terminology: essential, non-essential. This was a new reality for most clinicians. Most clinicians and most citizens believe that they're essential. So just to be told that you're non-essential is quite eye-opening. And then the manifestations and the ramifications of not being essential and being closed, I think, was very scary for a lot of clinicians. So beyond that, there's been a heavy focus on aggregation. Why? And why have clinicians voted with their feet towards MSOs and not towards health systems? These questions need to be asked. It's not like they didn't have opportunities to gain employment in the nearest health system. So what's driving them away from that? So I think what's also happening in healthcare, which is hard to explain, but it is happening, is the very structure of healthcare is being redefined. If in the past it was very simply rely on primary care to generate referrals, rely on specialists to offer themselves to those primary care referring sources, maybe rely on health systems as well to engage in some kind of referral relationship with their specialty network. And that's sort of it. That's the story of healthcare. We've moved into a world where businesses are becoming more and more dynamic and creative about defining what they do and why. Where are these patients coming from? B2C, B2B, ACO partnerships, IPA partnerships. Instead of just a retail aspect to healthcare, let's open more stores, a direct outreach to employers. There's a lot more strategic relationships out there, strategic partnerships, working with health systems in far more integrated ways, managing the entire continuum of care, the journey of care that a patient goes through, lifetime value of a patient, the networking effect of what it means to have a patient relationship, and the virtual component as well. So there's just so many different ways to create demand for healthcare and provide supply of healthcare, that just a very simplistic approach is antiquated, which is great news if you're an operator. It's not as good news if you're just a buyer, right? Because for many buyers, what they want is simple and repetition. I bought 5 practices this year, next year I'll buy 7. So I think the complexity isn't necessarily equally loved by everyone. But sort of, I'll repeat what I said before. If you're an operator, it's a really fun and interesting time to be in healthcare.
One of the things that lots of folks have been seeing, and I certainly have been seeing anecdotally, despite even deal volume in 21 being up pretty high and then coming down, is that even through the pandemic and even with large deal volume in 21, sort of initial conversation, LOI to close, has dragged out dramatically from where it used to be, right? And I wonder if you've got any thoughts about that and any thoughts about how that might change.
I have thoughts. I'm not necessarily legal counsel over here, so to the extent that there's some kind of legal component to it, some new due diligence aspect, I do think that the smarter the investor community gets, the more reps they get on how things might go wrong, the more effort focus has to be on compliance, getting into the weeds of the strengths and weaknesses of any given asset, really digging deeper. And so I think there is much heavier focus on more due diligence, and that speaks to timeline to close. I do think in a less competitive environment, things are going to slow down because, frankly, the pressure of closing quickly, otherwise you lose the deal to the second bid, weakens. I think the decrease in volume of sponsor to sponsor exits, which are usually the most efficient, the least frictional, that has weakened. So you're left with maybe more traditional buyers and sellers, more strategic buyers. And so this fluency of I buy and sell all the time, and therefore I expect to be told I have a few weeks to close, otherwise I lose the deal. That's more for a very buoyant market environment. I think concern about the asset, genuine concern about what I'm buying, more skepticism about the forecasted IRR, causes buyers to walk a lot more slowly and react more cautiously. I also think less deals getting done, more focus on the ones that are getting done, and buyers need absolute certainty on all things before they close, given all the added layers of risk. So I think that's sort of reflected in lengthier timeline. I don't know that the nature of the deal process has changed too much, other than in those states where disclosure requirements have been implemented. I don't know if it counts as 10 states or 12 states, but and I'm not sure of the timing of implementation of that new disclosure requirement. In some cases, it's still ahead of us. I think think California is April next year, but you can correct me, Ari. But in some states where new laws have been enacted, you're going to see an immediate change in timeline to close.
Yeah, yeah. I think just from a legal piece of what I was asking about. I mean, I actually don't think that a lot of that is legal in the sense that I haven't seen clients ask me to dig deeper, right? I have felt that at least a portion of what's going on is that if if I'm going to overpay and overlever right at this point to get this asset because I need to do something with my day job, right, as an investor, I just need to be 110% certain that this investment makes sense. And so I'm going to kick the tires once, twice, three times.
Yeah.
You
Also,
know,
if you're just the very essence of due diligence, my experience with due diligence, and I'm not saying that I'm, world champion in due diligence. There is no such tournament. It's not like arm wrestling, so it's all subjective. But my personal experience of it is 50% of due diligence is just time. That's half the battle, is letting an asset reveal itself to you over time. Now, a bankered process doesn't afford you that, because everything is about accelerating the bid to close, because to a banker, time is risk, right? To an investor, if you're afforded time, actually your risk profile goes down because you learn more as the asset. Is the asset seasonal? Is the asset able to retain its talent? Or with every added month, does another individual walk out the door? Promises are made by every asset in due diligence in any given moment in time, the moment they introduce themselves to you, right? This is who we are. And here is the evidence to prove that we are what we say we are. From that day onwards, every day is an opportunity to either verify that or disprove it. And so it goes to say that the logic is linear in that the more due diligence is required, the more time is probably required.
Yeah, and if I only had a little video to pull up right now, and there's very few people on this call that may in fact know where I'm going with this, but that idea of having more time to just keep digging, just reminds me of Detective Columbo, and is always got one more question, before he walked out the door.
I think that's a wonderful analogy. I think most private equity firms that we work with remind me in some way, form or fashion of Detective Columbo. They have that gene inside of them where they doggedly pursue.
And interestingly, though, I think, but look, it's the nature of the beast that transaction costs go up as a result too, though, in the sense that you give more people more time to think about what's going into transaction documents, to think about what more diligence they want to do, and you end up spending more money on those costs. But that's against making a bad investment, right? You're investing in an insurance policy to some extent, and so
look, what's the seller's mindset in this environment? How has that changed? Probably more skeptical of a successful outcome. So they're likely to allocate less resources towards an efficient process. If the CFO was being asked to dedicate all his or her time, now you're asking the CFO to dedicate half their time because you're not convinced that the closing will be there. The valuations have come down, so that also justifies less resource allocation. The exit is not that exciting. So the seller's more tepid as well. So it's a circular effect that the net outcome of which is things are probably going to move more slowly.
Yeah, I mean, you've seen, particularly in this space, right? You've seen folks pre-pandemic start to have valuations of even the one chair dental practice, right, be very significant. And if you are not concerned about all those other pressures that you ran through during COVID, and your practice has come back to where it was or it's gotten even better, you have the ability to say, I could slow walk this. I don't need to, run at full speed here because frankly, now times have changed. They're not offering me the same valuations that they would have offered me 3 years ago. And if I wait another 6 months, who knows what I'll get? And I think there's a little bit of that happening as
Yeah,
well.
there's caution everywhere. If you're a seller or a buyer, you're thinking of the most recent 5 anecdotes of deals that went wrong. Overpaid, too much debt, promises made about growth rates, and none of it manifested because growth rates based on continuation of heavy M&A activity have not materialized. So, there's the scrape and then there's the catch up and the make whole on lost income. And if you're a provider and you haven't seen that catch up manifest, you're calling your providers across the street, you're having dinner with them, and you're complaining. What happened to my deal? What happened to my EBITDA? What happened to my equity valuation? Why is all this money going off to pay off debt? And so you've got complaints. If you're a seller hearing that, you're walking more cautiously. If you're a buyer hearing that, you're walking more slowly, more cautiously. And so you're sifting through a much greater mix of good, mediocre, and terrible outcomes. Whereas in 2022, yeah, it's 95% great outcomes. And so caution to the wind, let's go. It's going to be wonderful. And any voices, any skeptics in 2022 are being drowned out as sort of, not party poopers because it's a bit childish, but they're just not with it. And then that's a shame. That's a shame. I really do think that in this industry, just like in every other industry, we have elements that subject us to a crowd mentality and a frenzied mentality. And if there's a few wishes that I have for healthcare, probably far fewer than the average person and very different than the average person. But one of those wishes would be I wish that we were somehow more resilient to frenzy. Just because we're all having fun doesn't mean we're protecting ourselves for what's to come. And it would be nice wouldn't it be nice if we took a quarter of last year's transactions, removed them from last year and applied them to this year at lower valuations? I think a lot of those buyers would take that deal.
Yeah, of course. Why don't we, it was so easy, right, for me to start off our conversation earlier by saying, well, look at this pitch book numbers. We're down 50% from last year, right? But why don't we talk about where stuff is happening in the deal marketplace and why? And even if you want to add to that a little bit of a crystal ball, where if you think, debt gets better to get, the debt markets get better and other things get better, that you feel like you're going to see a real jump into those spaces. So both, like, what do you think's going on right now? Look, we still have 50% of last year happening, right? What do you think would happen when things start to hit the pedal?
Well, I think that buyers with conviction, i.e. existing platforms, strategics, and there are many of them because they've all been formed over the last 10 to 15 years. If they're not completely upside down on their balance sheets, if they have capacity to buy, they're buying, and they're buying good assets because they know how to do due diligence. They're buying less, but they're buying, and they're able to focus on the smaller number of deals and get really good deals done, whether it's physical therapy that I was just part of, whether it's cardiovascular. We've gone and created the largest cardiovascular platform in the country. It didn't exist as the largest platform 4 years ago, and here it is today. CVA USA and part of Novocardia, the merger between the two. You've got entities that are forming, that are defining themselves as national leaders. You've got competition between potential national leaders, which is healthy, which is causing those candidates, those competing assets to push themselves along and continue to expand into new markets, continue to integrate, continue to unify in all different facets. unify around a strategy, unify around operational, unify around quality, unify around patient access, around strategic partnerships. So these assets are engaged in very healthy activities, but they do have one thing in common. They tend to really know their space. And I think there's a clear divide between that and, an investor that has a lot of available cash, but is reticent about putting it to use in a space they've never been in before. So I think that market has really quieted down. I think that market needs a lot more certainty and stability to put that cash to work. So those deals are getting done, and I think in individual categories, you've got different stories being told that are driving higher or lower levels of M&A activity. I think as you look at different single specialties, primary care is a very exciting space for many reasons, and continues to attract a lot of capital because of all the evolution going on in primary care. Home care continues to be a very exciting category. There's plenty to get excited about. There's groups that have demonstrated that they can be scaled. There's groups that haven't been scaled yet, but they haven't failed to scale either. I think neurology is sort of people have tried and they haven't really enjoyed the experience. But I think there's very few examples of that. So for the most part, most of these groups, vascular is such an exciting space. What used to be sleepy podiatry is now podiatry, vascular, heading into cardiovascular, and who will be the true leaders in that space over the next 5 to 10 years is maybe even less over the next 3 years. That leader, national leader, will emerge, just like it has in other single specialties. And there'll be at least 3, 4, 5, 6 other semi-leaders that will create tremendous value along the way, in a space that used to be, OBL dependent and then subject to significant deflation because of reductions in reimbursement rates. You're seeing quite the opposite. You're seeing rampant growth and the introductions of surgery centers and cardio outpatient procedures to fuel that growth, and the combination of interesting referral patterns between these different elements. So very interesting space. You're seeing the continued need for deflationary focus from health systems that continue to struggle with their ever-inflating budgets, while still seeing revenue decrease. So that's forcing health systems into change, pushing out anything that is inefficient for them and offering that to the marketplace, offering it in the form of very interesting strategic partnerships, the constant redefining of what a modern health system hospital is. Very interesting from an investment standpoint. And I think we've always said this, that these aggregating MSOs and their practice roll-ups are just the first phase of a multi-phase evolution. And frankly, the least interesting, by far the least interesting, right? What gets exciting is when you have a hospital strategic partnership department in your MSO filled with people, 50 people in that department. That's exciting. A corp dev department that knows how to find more practices to acquire in Texas is just the entry point and is not really sustainable on its own as a long-term differentiating strategy, because frankly, anyone can put money to work, especially at any price, right? But can you build tremendous relationships that will pay dividends for decades to come? So it's, again, a really interesting time.
Yeah, I think it's interesting what you say about the hospital partnerships, in the sense that when you think about it, look, physicians and hospitals, for a very fundamental reason, have always been partners, right? They can't afford not to be, and just structurally they have to be. But the there's the way that the PPM industry has reemerged, right, in the last 10 years, makes it very interesting as to who in particular marketplaces becomes the sort of dominant healthcare player, right?
Yeah.
Does it become the large multi-specialty PPM that essentially rolled up 60%, 70% of the multi-specialty physicians in the marketplace with the 2 or 3 hospitals that are there? Or does it become the 1 or 2 hospitals that essentially acquired 40, 50, 60% of the physician practices in the marketplace?
Yeah.
Who knows, right?
Yeah. So look, when you break down any company in any industry, you find partnership after partnership after partnership, right? A car is not made by Ford, right? Car is made by Ford plus its 100 preferred vendors. Each of those vendors is probably an international company. If you're supplying Ford, you're probably quite large. You're probably not even based in the US, and you probably have a multi-decade history too. If you and I, Ari, were to launch a company tomorrow and knock on the door of Ford in an effort to try to give them something, we'd probably get turned away unless we came up with something so ingenious, and the odds of that are really low, for me at least, maybe not for you. So what does all that mean? It means that when you see a lot of new entrants do reasonably well in a marketplace like they have in healthcare services the last 15 years, it just means one thing: the barriers to entry are very low. Anyone can enter. But what happens after that? The barriers start going up by like a foot every month, every year. And you can see those barriers. Where do you end up? You don't end up with one supplier in Arizona. You might end up with one monopolistic supply in an aspect of healthcare, but they're going to need insurance, and they're going to need beds, and they're going to need technology-based solutions. They're going to need a lot of things. But as these assets grow and become dominant, they squeeze out alternatives in their space, and they actually necessitate much stronger partners to deal with their size. And so actually everyone grows in size amongst the winners. And what you move from is, and everybody knows this, an immature industry that is defined by the number of participants to a mature industry that is defined by a much smaller number of participants. And that's just the nature of things, right? Things get better and harder at the same time. And as they get harder, less and less people are able to claim that they do those things.
Yeah. Let's invite folks to ask some questions. We still have about 10 minutes. I mean, I know you and I still have a couple of things we could easily talk through, but I'll before we do that, let's see if anyone has, let's give an opportunity for anyone who has a question to throw it into the chat, and we'd be happy to see if we can address any questions anybody might have. So here's an opportunity for you to, it's always that first question that we need that all of a sudden opens the floodgates. But if anyone has anything that they'd like us to talk about, please feel free to, as I said, throw it in the chat. I'll give it a little bit more time, and then we'll talk about some other things we were going to talk about. Okay, so hearing none. This is we had thought about this the other day when we talked, and let's think about it now, which is kind of putting aside the investment itself. Let's just talk about the operations of a PPM, and let's talk about two sides of a coin. One is sort of what kinds of things make PPMs successful, and the other side of that coin is that what makes you see that they're just mismanaged. They're not doing it
right. Well, there's sort of both sides, two sides of the same coin. The sources of bad performance range from department level poor performance, so a bad billing operation, whether it's outsourced or insourced, bad finance and accounting operation that can't get its reporting together, bad systems. It's not the finance department; it's the systems that support the finance department. Poor integration. They've acquired assets that don't integrate well from an information consolidation standpoint, from a behavioral standpoint. We say culture, but culture is behavior. You either have conformity and consolidation around stated goals, or you don't. And so wide variance while you're trying to scale is not a great friend to, a defined mission. It might be a beautiful concept. Everyone gets to do whatever they want around here, but you can't have both. You can't have everyone does whatever they want and we have a clear mission. And most of the time, if you're going to do well as an asset in healthcare, which means risk management, which means a differentiated strategy, clarity and mission is part and parcel with that. And so being all over the place is usually not a winning strategy. And that's hard because a lot of these assets actually they have plenty of opportunity. They should be experimenting to some extent. There's no guarantees out there. You can do just the one thing and find out that you've been outmaneuvered by a competing asset that has adopted another revenue stream and offered its clinicians another source of income, offered its patients another service. So there is pressure that one shouldn't avoid and ignore. But the balance of diversifying, experimenting, being creative, and also being able to build a business that you can maintain control over is an important balance. It's a difficult one, but important one. Lack of investment, too much capital allocated in the wrong places, if at all, and too little investment in things like compliance, too little investment in this little thing called talent. Really, who are the people working at your organization? How hard, how invested, how passionate, how caring are they? They are your front line and your last line of defense, right? Them worrying about a given department and its needs, a patient, a provider, a strategic partner at 7 o'clock at night on a Sunday is the difference between doing well or not. If they're not going to focus on it, no one else will. So are you invested in your own people? The culture of the organization, I think most important as a differentiator for these MSOs is, and frankly gets spoken about least of all, is the speed of change, right? So the good MSOs that we see and fall in love with as observers, if not as consultants, if not as investors, working alongside institutions, they put a speed limit on themselves. They just refuse to grow above a certain rate. They refuse to acquire more than X assets per year, no matter what. They refuse to hire more than X people. They have a strict speed limit on what they're willing to do in any given year. And it's so understated and yet so heavily correlated with success. It's not growth at any rate, at any time, whatever we can get away with. And so I think that's a very hard thing to commit to, especially when you have all the capital in the world. And especially when you have a history of doing nothing but well, right? You think that your car can go 300 miles an hour. Why not? You've never crashed before. But someone needs to tell you that the car was only built to do 80. And so it just won't work at 300. It's just a matter of time. So, investment in leadership, defining leadership very broadly, understanding that if you're going to call yourself the number one GI MSO in Minneapolis, then that means many things, and other people have to agree with you. And it's not just an EBITDA test or a growth test. There's many aspects to being a leader in the community, and healthcare remains a very interesting industry. It is not the same as selling shoes. So being part of the community in many ways, contributing to the community, thinking about the community's broad needs while also staying focused on your mission. Again, it's hard to get it right, but that doesn't mean you don't have to do it. So lots of things correlated with success, overpaying for assets, over-levering those assets, relying too much on physicians that are close to retirement, getting very large liquidity events to still perform at a very high level, and not having a plan B if they don't, is heavily correlated with failure, especially in a highly inflationary environment where the cost of everything is going up. So those are sort of some of the ingredients that tend to surface time and time again.
You raised leadership, and one of the things that I've seen, among many other things that you mentioned too, is just almost a failure in in making the right decisions about leadership, and in two different ways. I've seen, for example, PPMs that are on a streak of acquiring practices, and promise the large practice that they acquired today, the founder of that practice, to be the so-called CMO, for lack of a better term. It could be called just 1,000 different things, right, of the entirety of the organization. And then 3 months later, say to me as their counsel, hey, we're terminating their CMO agreement. They're gonna that practice is still going to work with us, but we found that doctor, he or she, to be not the queen or king we wanted. They're driving us crazy, and so we're acquiring this other practice in this other state, really large practice. We're going to anoint that person. And it's just, I've seen it send a really horrible message across the organization of, literally every 4 or 5 months, there's a different doctor who's in charge of everything, right? Forget the operational management, right? And it's we just didn't see eye to eye with that person, and it's like, is it really that? And I'm asking this rhetorically, right? But is it really that difficult to find a physician that you do see eye to eye with, that you don't have to keep running through folks, right? And I've seen that interestingly in so many ways. It's just I don't understand why there can't be a better way to get past that issue, right?
Yeah, this the reality of this being a people business, people assets, is lost on a lot of decision makers who control and own these assets, because they're far removed from 99.9% of the people. Their interaction is usually with the CEO. Maybe the CEO brings the COO or the CFO to a board meeting as well. That's about it. And maybe they have an annual presentation, a town hall with a larger group of providers, maybe. Maybe they spend time on an occasional visit to a practice. But those are very random events. And so the one recurring cadence is with 1, 2, or 3 people in an organization that has 50, 100, 500, 1,000 very influential voices, extremely influential voices. These are very, very well-educated, highly experienced, in many cases, if we're talking about clinicians, former CEOs themselves, of multi-million-dollar businesses all over the country. And they're not going anywhere quietly. And every promise made is a promise remembered. Whether you made that promise directly, in person, in an email, or indirectly, vicariously, through one of your representatives, you're held responsible. And so again, back to the speed limit, just thinking about that, these businesses can't actually move that quickly, because any movement should be preempted with a meaningful communication outreach. And back to your question about MSOs that shine, they spend more time, effort, and resources on internal communication than they do on external communication. And they should be spending a lot on external communication, even more on internal. So yeah, there should also be like a margin limit on how well these businesses are doing. And it's very tempting to take the extra 5% of margin and be even more profitable. But the right move is to not take it and say, we have a good business. How do we protect that business? How do we invest in sustainability? You need the right culture, and I hate to say it, but if you're really focused on exiting because your 3 years are up, maybe you're not focused enough on sustainability. My other wish for our industry, I wish everyone spent 99% of their time thinking about sustainability. Maybe not 99, maybe 50, maybe 30% of the time on growth. I don't know what the last 20% is. Return of capital to investors, sure. but a huge amount of time on how do we sustain what we've built. And I pray that all the investors out there think about their legacy in terms of the assets that they've owned and not just in terms of the IRR that they generated. I know they do. I don't want to be overly reductive. I know there's a lot of good people on the investment side. But the nature of the industry and the pressure that LPs put on investors to generate return, and they don't, what do they care about an asset, after it's long gone and been sold? But the GPs, I hope they care a great deal more. I suspect they do. They've owned these assets. These assets belong to them, and they made promises going in while they owned them, while they exited, and so the word sustainability, I think, should mean a great deal more should continue to mean a great deal to all these investors, and hopefully mean even more, especially during easy periods when growth comes easy.
Yeah, I don't disagree. And on that note, we're going to wrap up. Roy, has always been a wonderful conversation. I appreciate you taking the time today to have it with me. I want to thank all of our attendees for joining us today as well. And we'll sign off with that being some parting words. Roy, if you got anything you want to add, feel free.
Ari, thank you so much. Really appreciate it.
Thanks. Take care, everyone.
Take care.